Hi, everyone, and welcome to today's webinar. My name is Ida Johannesson. I'm Head of Commercial ESG and Education at Saxo, and I will be your host. Today's webinar, Understanding the Different Investment Products, is part of a series of webinars that we have designed at Saxo to help you understand the world of investing better. Last week, we covered the importance of investing, and next week we'll have something about how to build a portfolio. But back to today, it is my pleasure to introduce Kenneth Lamont, and I'm just going to share my screens now. There's always technical difficulties, so give me a moment. So it's my pleasure to introduce Kenneth. Kenneth is a principal within Morningstar's Managers Research Department. He's worked extensively with passive fund research and is now leading Morningstar's research on thematic investments. Kenneth is a prolific writer, having written many research papers, and is regarded as an expert in the industry on both passive and thematic funds, and appears frequently as a speaker at conferences and as a commentator in the financial media. And today we have the pleasure of having him. Kenneth has a Master's of Science in Investment and Finance and an Executive MBA from the University of Cambridge. He also holds the Charter Alternative Investment Analyst designation. Today, the agenda for the webinar is as follows. We will cover the different types of investments, the power of diversification, the different investment styles, how the different products perform during different market scenarios. At the end, we have reserved 15 minutes for Q&A, and we also have a short survey. We would greatly appreciate it if you could answer a few questions and provide us with your feedback. It helps us serve you better and improve. Now, before we get started, just some important information. Today's webinar is for educational and informational purposes only and is not a recommendation. Investing is risky, including the risk of loss. As a general rule, you should only invest in financial products if you understand the risk associated with those. Past performance is no guarantee of future results, and before investing, you should consider your investment objectives, time horizon, and risk appetite. Okay, so now over to you, Kenneth.
Okay. Yes, hello everyone. I'm having some slight difficulties here. It's not allowing me to share my...
Okay, if you want, I can share for you if you're having difficulties sharing your screen. But I think actually, can you just try again? Because then we can have both you and your slides on the screen.
Yeah, it just isn't coming up. I could...
I'll share for you. That's fine. Let's do this. I'll share for you. Yeah.
I can do this. Does this work?
Let me see. Yes, he does.
Yes. Hello, everyone. Apologies for that.
No, actually, it doesn't work.
Oh, it doesn't work.
No, let me share your screen, Kenneth. Sorry about that.
Okay. I'm not sure what's happened. Yeah, we actually went through this prior to our meeting. But anyway, hello everyone. As Ida says, my name is Kenneth. I spent more time than most looking at financial assets of all different sorts. I currently work for a company called Morningstar, where I am a senior fund researcher, effectively. So I've had a lot of experience looking at a lot of the instruments that we're going to be looking at today. Which I can't actually see what's being shared here. Do we have the first screen?
I'm sharing the first screen, yes.
Okay, so I'll have to run a little bit blind. Oh, here we go. Yeah, so today we're really going to start with the basics. I would prefer this to be not just me talking to you. I'd prefer this to be very interactive. I'd love it if you asked questions, if you interrupted me. Some of this might be basic to some of you, not to others. I'll try and make it as interesting as possible. Okay, so to kick off, what is a stock? Well, a stock is a form of equity, and I think it's important right at the very beginning to distinguish between essentially equity and stocks. So when we talk about stocks, we're talking about public equity, and we want to sort of differentiate that from private equity. So some of you will have heard of sort of venture capital and private equity firms. They essentially deal with equity, so ownership of a specific company, which is not traded on exchanges. And we're not really going to talk about that today. But just to define what we're talking about here, essentially a stock is a bit of paper that gives you ownership of or gives you a claim to a given company's assets and profits in the future. So if you go onto your trading app and you buy a Shell stock, you're essentially buying a portion of that company. So you can think of it as essentially ownership. Stocks themselves are traded on exchanges. So in the UK, you would most likely trade on the London Stock Exchange. And this is something a bit like eBay. Right? Every day on eBay, I would imagine thousands, potentially many thousands of identical iPhones are traded on eBay. This is much like a stock market. Very, very simple. Thousands of people coming together and interacting. They're very, very efficient, and there tends to be a lot of transactions throughout the day. So if you want to sell or to buy Shell, you go to the market and you can transact immediately. So what are you actually getting when you buy this bit of paper? Well, a company decides you're essentially getting the potential growth of that company in the future. So if the stock price goes up, but also companies choose whether they want to pay dividends or not. So this is them choosing to pay a portion of their profits to you as an investor. And this can be very different for different companies. So for example, Amazon and Tesla have never paid dividends. This is because as a company, they feel their growth potential, it's better for them to invest in their great ideas and to grow the company than it is to pay money out to you. Whereas, let's say a big tobacco company or a utilities company, actually their selling point from an investor's perspective is that they provide a regular stream of income for you. They potentially have less growth opportunities, but they have a really solid business with sort of strong revenue streams. So what else can you say about stocks? Well, owning a stock, and this is quite important as well, is you are owning a company, and actually you get an ownership right. So you can vote on shareholder resolutions as well. So these are actually, it's your participation in the running of the company. So you have a right to vote on important decisions that are put to shareholders, which is worth mentioning and might come up again later. So what are the characteristics of a stock? Well, they tend to be fungible. So that means it's a fancy word for interchangeable. One, you're buying a percentage of the company. If you buy more of the bits of paper, you own more of a percentage of that company. They're generally easy to buy and sell. As I said, you can, as long as the market is open, you can trade them quite easily with other people at relatively low cost. They can be very volatile depending on the stock, and we'll go into that a little bit later. Some of you may have noticed that the largest company in the world dropped 20% on Monday, Nvidia. This was quite shocking for the market, but this is clearly, highly volatile. Nobody really wants to see their investment in any single stock dropping 20% in one day. So that's definitely something to consider when you're investing, particularly in single stocks. However, there are some stocks, and again, we'll touch on that later, that might be more appropriate for if you've got a less risky worldview or a lower risk tolerance, perhaps. Secondly, we'll go on to bonds. So we've covered stocks, which is potentially what most people would think about if you ask them about investing. Bonds are also very common. They've been around.
Can I just interrupt? We have two questions here. One from Nathan, who's asking, can you please just elaborate on small, mid cap, and large cap? And then I have another question from Maria asking, how come the largest company in the world can go down 20% in one day? Is that normal?
So for a start, no, it's not normal, but we're not living through normal times. I was actually meant to be on CNBC at 6 a.m. Yesterday morning talking about this, but they bumped me in the end. No, it's huge. It's huge for the market. And essentially, in fact, this is a fantastic question because it really boils down to what's driving a stock price. And essentially, you have, and we're going to get into the size later, so I'll answer that question in a couple of slides' time. But essentially, the valuation of NVIDIA and other AI stocks was based on an assumption as to looking at their business model. How much investment does it take to build a model that will be market leading, and how much can they charge that? How much can they pass that on and charge us as users and other potential users for that service? And essentially, this very small Chinese startup demonstrated that they could do better in some cases, or at least similar, produce similar quality results or similar quality products, models, AI models, for much less money. So suddenly, these business models, these elevated prices that we saw in the market, suddenly everyone was scrambling to try and reevaluate. What does this mean if the assumptions for the valuation of this company have changed immediately and dramatically? We were all wrong, and suddenly everybody then piles out of the market, which is, but I'll say it's not very, very common. It tends to happen more to technological stocks with big sort of growth potential. And I'll just elaborate slightly further in the sense that for those of you who are interested in AI, the assumption was essentially that the best language models are a combination of the broadest and deepest data sets, and then just brute force computing power. And essentially what this Chinese startup has done is it's shown that by being smarter about how they build the algorithm, you don't need that brute force power. And so NVIDIA, it was the largest company in the world because it made the best chips. And there was this became a bottleneck. So the best computing power, the most powerful computers used the best chips. And because NVIDIA made the best chips, they were really, really in demand. They held this almost natural monopoly, as we would say. So this is why this whole view of AI investing was subverted somewhat the beginning of the week. And that's why we saw such a dramatic change. On the question to do with sort of mid, small, and large cap, I'll get to later a little bit. But first, I'll jump onto the other very, very common investment instrument used to invest. And so both stocks and bonds are very, very old. They've been around for a very long time. So a bond is essentially an IOU. It's a loan that if we're the bond buyer, that we are giving to whoever is selling us that bond. So that could be a corporation, that could be Microsoft, it could be a government, it could be the UK government. So when you buy a UK gilt, essentially what you're doing is you're lending the UK government money at certain terms. Okay, so when you buy a bond, if you go out and buy a UK government bond, what they'll do is they'll say, okay, it's a 5-year bond. If you buy it today and hold it till maturity, you will get your money back and you'll get the interest rate that we've agreed to pay you on top of that. So a 4% bond held every year. You get your coupon, as this return to you is called, so you get your principal back, so the amount you paid plus the amount they've paid you, as a sort of as an interest rate, effectively, to thank you for lending them the money. Now, bonds have a very different investment profile. So, as we discussed with NVIDIA, you're essentially buying the future prospects of the company. But these can change very quickly, as we just saw. Something changes in the market, a new medicine comes, and suddenly your products don't look quite as competitive, or something's happened, and the stock price reflects that very, very quickly. Fixed income is slightly different. If you buy that bond and it does not default, so whoever you lent it to does pay you back, and you hold it from the beginning to the end, you know exactly what you're going to get. So the main risk here is actually that something happens and who you've lent the money to can't pay it back anymore. So that could be the US government. If one day the US government lends too much, it can't pay the interest anymore, that would be known as a default, and perhaps you'd get less. You in some cases none at all, but you'd probably get a percentage of the amount you lent to them back. So you can look at it as somebody lending. You lend to your friend at school to buy their lunch, on the understanding they're going to pay it back tomorrow. If they're not very trustworthy, maybe you charge them more interest for it. And the big risk for you is that they just don't turn up to school the next day and they've left, and they don't have to pay you back, right? So the main risk with sort of bonds is that there's going to be a default and you don't get your principal back, which is actually a very different investment sort of payoff structure compared with equities, as we looked at before. There's also interest rate risk as well. So if you want to buy and sell bonds through time, generally speaking, if interest rates go up, so I'm not sure how literate everyone is, but the Bank of England in our case, or the US Federal Reserve would sort of raise interest rates, this would actually push bond prices down. And I'm happy to go through the dynamics of that. But essentially it means that, let's say you bought a UK gilt 5 years. We're 2 years into that, and suddenly, with interest rates falling, that means the UK government can pay you less for. If the interest rates are higher, that means they're effectively offering somebody else buying a brand new bond more reward than your one, right? So your contract or your loan is actually worth less, and it goes the other way too. So if interest rates fall, then bond prices tend to rise. So that's the dynamic to remember. Again, if you are interested, I'm happy to go into sort of more details around that. But that's really the basics of bond investing. So what are their characteristics? Well, they're non-fungible. So that there's this word again. Equities, as I mentioned before, can be sort of interchanged. With bonds, they can be very, very different. So you could buy a 5-year bond at a certain interest rate, but they've got a 7-year bond they issue at a different rate again, and they get issued in batches. So it's not the same fundamental characteristics as you would see in the equity markets. They're difficult to buy and trade for an individual. You need to buy an entire bond. You can't just buy small amounts and trade them. So in many ways, they're not particularly accessible to the individual investor. But generally speaking, their big plus is they're much less risky than stocks in general. Now, that's not, I just want to stress actually here that everything I'm going to say here are generalities. We're working in, investing is not a science, and for every rule, there is also an exception. So it's really worth mentioning that. And again, I can go into what those exceptions are in each case if we'd like to. So there are different types of bond. There are government bonds, as I talked about. That's you lending to a government. If maybe you want to lend to the UK government, as we said, by buying gilts. We have corporate bonds. And we also have the third thing to think about here is ratings agencies. So some of you may have seen headlines where UK gets downgraded, Ireland gets downgraded, etc. What does this mean? Well, we have credit agencies that sit outside, they're independent, and essentially they're watching debt, and they change their outlook on different types of lending, so whether it's government debt or corporate debt, based on the fundamentals and whether they think it's likely that this party is going to be able to sort of pay back. So they're an independent third party that sort of sits there and gives ratings to bonds. So when you see a downgrade, what it really means is that these experts who spend all day looking at this have said, look, it's actually less likely that the UK is going to pay this back in 10 years' time or whatever it is. And finally, we're not going to dwell on this.
One question. Yeah, we have a question here from Jason, who's asking, how safe is it to invest in an investment grade bond from a government if I choose to hold it till maturity?
Yes, very, very safe. So these are considered to be some of the safest investments that you can make if they're, so again, going into the grading, when you talked about investment grade there, this is coming back to the ratings agencies, and they've essentially given this the highest grades, or AAA type of thing, or anything with A is investment grade, then it goes down to B, etc. And so they've essentially, these independent third parties have effectively given this the highest level of conviction that we have that these borrowers are going to pay back what and when they said they would. So if you're going to allocate and you're really risk averse, then it would make sense to allocate to sort of highly rated, particularly sovereign debt. So that's very important to understand. So in general, you've got bonds which are lower volatility, they are safer, but they have their own specific dynamics. Equities tend to be much more volatile, but there's a much greater upside potential. So with a bond, the best you can do is to get back the amount that you signed up for. With equity, the sky's the limit. If you buy a small cap that suddenly finds a cure for cancer, suddenly you might be getting 20, 30 times your returns. But equally, that same stock may not, the trials don't work, and suddenly you end up with nothing. So there are definitely different dynamics here. And generally, when you have a diversified portfolio, you would mix these two together to give you the type of exposure that you're looking for. So again, I don't want to dwell too much on other, but there are other types of investment. There is crypto, there's gold, there are commodities, and each one of these has their own investment dynamics as well. So when it comes to commodities, you can't actually go and buy a sack of wheat, but you can buy a contract which gives you exposure to that wheat. I would say, unless you're an expert, I wouldn't spend too much time looking at commodities, but they do have an interesting payoff profile. So with bonds, you normally get sort of very, very steady returns, but then maybe there's a panic or a default, and you'll get a drop in your value. Whereas with commodities, they're highly volatile, but they actually spike at times of crisis. So if you have an energy exposure, suddenly Ukraine war happens, you'll suddenly see this demand spike for energy or supply shock, and you'll see these sort of spikes. So they have a very distinct risk and return trade-off. As does gold. You can just buy gold and put it under your bed, but you have to protect it, and selling it is costly, and you have to go and find someone to buy it. But there are products as well that give you, you can buy an exchange traded product which will just give you exposure to gold without actually having to have it under your bed. And finally, crypto. I'm sure many of you will be interested in crypto. I would be cautious. It's highly volatile, and it's very difficult to assess fundamental values, which we'll come on to later when we're talking about other assets. Okay, next slide.
Just one question before you go on to the next slide. You've covered those instruments, stocks, bonds, others. Can you just elaborate a little bit about how they move? Do they move together in the same direction, or do they move in opposite directions at times?
Yeah, they do. They do. I mean, it's fair to say that the financial world is highly complex, and as I said, it's not a science. But for example, gold it doesn't have much intrinsic value, and it's mostly driven by sentiment, and essentially it's seen as an investment of, let's say, last resort. So you would expect to see gold spiking at exactly the moment that equities were crashing. So if we look at the COVID-19 panic, no one knew what was happening. Everyone thought maybe we're going to be living in a decimated world. Though I'm sure many of you had your own views, but the markets really, really crashed. And if you looked at the price of gold around that time, I'm sure it spiked. It spiked in sort of response. As I mentioned before, commodities seem to have their own sort of cycle and sort of peaks and troughs. Equities and bonds tend to move. I won't say they're completely negatively correlated, but they are. They do tend to do well at different times in the market cycle. So when you see expansionary monetary policy, which is low interest rates, cheap borrowing, lots of investment, high growth, equities tend to boom. But the safer fixed income tend to do very well or comparatively well when markets are suffering as well. So they have different properties. And by mixing lots of assets with different risk and return profiles and different investment drivers in the same portfolio, you can achieve a level of diversification. I'm one of the founders of modern academic finance. Henry Markowitz said that the only free lunch in finance is diversification. And there is this magical principle that, the best way of describing it, we have a phrase in English: don't put all your eggs in one basket. Essentially, if you diversify across many, many assets, you diversify away they call it idiosyncratic, which is a fancy word for the stock-specific risk. If you buy one stock, you just get the return of that stock. But you're also exposed to all of the risks associated with that stock as well. And you can end up with nothing quite easily. But if you diversify across everything, you can actually sort of minimize that individual risk while still remaining exposed to the general returns of the market. So you cannot go out and buy a commodity. You cannot easily go out and buy and sell bonds. You can do it, but it's not particularly easy. So how can you do it? Well, you can invest in funds. So funds have been around for a very long time as well. And traditionally speaking, it's essentially you, as someone who doesn't know much about investing, you go to a professional who does, and you give them your money, and for a fee, they will invest it towards a certain investment outcome. So usually that outcome is to outperform the broader market, whether that's fixed income, whether that's equity, whether that's both, etc. And they make calls as to how to, which sort of assets to buy, which assets to sell, etc. And they try and outperform the broader market. Again, these are diversified products, so it's not just one or two stocks. There's generally sort of a minimum of sort of 15 to 20 stocks, probably even more than that, but they can go up to thousands of stocks that these managers hold. And so these funds tend to be the traditional structure. If your parents went to invest in a mutual fund, it would be a traditional mutual fund, and these are priced once a day. It's a bit like going around to the corner shop to buy some milk. You don't know exactly what price the milk is. Doesn't really matter. When you get there, you'll find out, etc. But it takes a bit of time. It's a bit slow, etc. So when you buy the fund, you don't even know exactly how much you're paying, because you have to wait until the time of day that it's priced, and then you interact with the fund company, etc. So it's sort of an old-fashioned, fairly stodgy way of buying into a fund. Enter ETFs. ETFs are one of the major success stories, we could say, over the last 20 years in financial markets. And essentially, they take whatever you can wrap in a fund and put it into a much more dynamic wrapper. And so the ETFs are traded like an equity throughout the day. So when you buy it, you know exactly what you're paying for it. And in fact, you can buy and sell it throughout the day. So this is quite revolutionary. They also tend to be much more transparent. So when you buy an ETF, you can see exactly what the holdings are, and they tend to be very low cost as well. And so it's not strictly true, but traditional mutual funds tend to be the home of active managers. So we'll get onto a bit more about them in a moment, but it's not true. There are also sort of index or passive strategies that you can buy in the mutual fund structure. And ETFs have been traditionally associated with index investing or passive investing, and that isn't strictly true either, because there is a growing part of the market that is actually active as well. So the best way to see these two structures is one sort of an old structure, the other one's newer. It offers a few more benefits to you, and is generally what you'll find on sort of modern sort of platforms, potentially, well, certainly on Saxo as well.
Can you just elaborate a bit on the tax efficiency of ETF versus mutual funds?
Yeah, so actually, this is not on the slide. I don't think, or it wasn't. Maybe I took it off. So the tax efficiency is mainly in the US. So for European investors, that's not something to worry much about, and it's actually something that's really grown the ETF market in the US, which is just enormous these days. And actually, it's fueled the growth of active ETFs as well, because literally you get, as an investor or as an asset manager, it makes financial sense for you to launch into this ETF wrapper. Whereas in Europe, there is no explicit sort of tax advantage. And so, as I said, the traditional mutual fund is the home of the traditional active manager. This would be your star managers, your former star managers, like Neil Woodford, for example, would all have mutual funds. And ETFs have traditionally been sort of S&P 500, FTSE 100 trackers and other index-based strategies. So it's changing now, but that's generally that has generally been the perception. Okay, next slide, please.
Sorry, can I have one more question from Pia? She says, one would ideally like to invest in ETFs such as the MSCI World to achieve diversification. However, a significant portion of the value is now concentrated in some of the largest companies. How would you suggest achieving this diversification?
That's a great question. My team have published papers on concentration. So what the question asker is really asking is that, how diversified are you if the Mag 7 hold, I think they hold, as of last week, they held a third of the weight in the S&P 500, which is, with just 7 stocks. So how diversified really are you? And so when we talk about passive or index-based investing, what you're really talking about is there's a very transparent set of rules that are being tracked by that fund, which is, so you're not paying a manager to do it, but you're installing some sort of intelligence into that index and you're tracking it. So another version of an index strategy might be an equal weighted strategy. So these have become popular recently. So instead of buying the whole market, like the MSCI ACWI, as you mentioned, which is the whole world, by the way, it's the whole world, the whole developed world market, and you're weighting them by their market cap. So the largest companies get the largest weight, and then the smallest company in that set gets the smallest weight every day. And essentially the power of that is that you're harnessing the wisdom of the markets. If you think markets are efficient, this is the way you absolutely should invest at a very low cost. And it's proven itself to be very difficult to beat. However, there may be flaws. You may not believe. There may be moments when you think the market is not efficient. And you can argue that this week showed that, right? That actually the biggest, most profitable companies are expected to be profitable companies in the world show themselves to be much less potentially profitable than the market previously expected. So you saw this big sort of drop. Well, there's one way you can protect against that. You can invest in an equal weighted strategy, which essentially gives the same weight to Apple, which is one of the biggest companies, as to one of the smaller, let's say, S&P 500 companies, if you were to get an equal weight S&P. Or you can get, or if we're looking closer to home, you can get an equal weight FTSE 100 strategy, which would be doing something similar. And essentially what that is you're overweighting the smaller companies versus what the market has has determined is efficient, right? So the market has the biggest companies, your Shells in the UK, etc., and then it's suggesting that they are worthy of more investment. They're the largest, and then the smallest, such as I think Games Workshop was entering the FTSE 100 at some point, wasn't it? That would be weighted least. But in an equal weighted strategy, they would have an identical weight, which gives you an actual exposure to much smaller companies. It gives you potentially unexpected exposures as well. So it's important to understand what else you might be getting yourself into when you buy an equal weighted fund as well. Does that answer the question?
Yes, he does. And I'm now showing the next slide.
Okay, perfect. So we have different investment styles, and this is one of your previous questions. How do we slice and dice the universe, in this case, equities, to invest? How are they different from one another? Well, two of the major categorizations of equities in the world are value investing stocks or value stocks, and growth stocks. And these are, as you might imagine, a value fund, a fund as well. A fund would invest in value stocks. A value stock or a value company is one that is perhaps out of favor. It's got a low, as we say, let's say price to book value. So as in the price is not factoring in much growth, essentially. This company is maybe in a dead-end industry, or the market is just really excited about something else. And on the other end of the spectrum, you have your Teslas, you have your Amazons. They're expected to grow so much that they keep all of their profits to reinvest. They don't even give them out as dividends at all. So on the value end, you'd expect to see companies, maybe utilities or sort of unloved companies, maybe British high street stores. Everyone knows that's sort of a declining industry, etc. And essentially a value investor would pick through those and say, actually, there's maybe there's something to be gained here for sort of buying something when it's cheap. Detractors of value investing would say that it's cheap for a reason, probably. If the market's efficient, then there's no real advantage to be had by sort of buying cheap stocks. But anyway, so you can see that this is it's a very, very widely accepted sort of spectrum. On one end, you've got high growth stocks that are expected to grow. On the other, you've got those that are not really expected to grow at all, but might offer you some sort of buying cheap opportunity. Warren Buffett, one of the world's most famous investors, is also the world's most famous value investor as well. So if you follow his type of investing, you'd be following a value investment strategy. And so as you can see on the slide, this is a very famous intellectual property, IP, from my company, Morningstar. It's called a style box. And essentially it plots companies and funds that hold those companies on this sort of matrix. And you can see along the top, you've got value, blend, and growth. So this is where these companies sit on that spectrum. And then also you can see large, mid, and small. And this is what your previous question was asking about. You can split the universe into these mega caps, these very, very large companies, your Apples, your Metas, your Teslas, etc. But also, of course, there are many, many, many much, much smaller companies. And actually, this market segmentation can tell you quite a lot about how these stocks are likely to perform. So small stocks, for example, tend to be much, much more volatile. Of course, we saw with NVIDIA yesterday that isn't always the case. Sometimes large companies can be volatile too, but on aggregate, smaller stocks have performed very, very well over long periods, but you have to be willing to take more volatility and a little bit more risk. And of course, mid caps sit somewhere in between as well. But this is just a way of segmenting the market to allow you to play different cycles as well. So when markets are booming, small caps tend to do well because they're riskier. In market downturns, maybe they have only one product line, or they have limited access to credit or other reasons, and actually then they suffer more on the downside as well. Do you have any questions there?
No, we can wait until the end.
Okay, perfect. I've also written here meme stocks. I think the less we say about these, the better, but it's worth mentioning. A meme stock is something that has appeared, I suppose, over the last few years. This is GameStop, this is Bed Bath and Beyond, and these are stocks that are essentially hyped up well beyond any intrinsic value that they have for reasons that are essentially momentum driven. And most investors don't, fear of missing out is not an investment strategy. Very few people got very rich by investing this way. Generally speaking, by the time you hear about it, the moment has gone and you'll be buying at exactly the wrong moment at the top of the market. So it's important just to sort of warn you off just piling into the hottest new thing, particularly if it's coming from a place like Reddit. Something close to my heart, thematic investing. This is something relatively new, its popularity, and this is investing by theme. So whether it's artificial intelligence, aging population, you're essentially picking a narrative, a development in society or in technology, and saying, actually, what's the value chain of stocks or investments that give me profit exposure to this through time? So with AI, you wouldn't just be buying those with the data sets. You might be buying the chip manufacturers. You might be buying energy companies that are supplying the energy needed to power these big sort of AI centers, etc. So really, you're cutting across a value chain connected with, in this case, a technology, but it doesn't have to be. And they could be a specific sort of cannabis investing, which was quite popular a few years ago, but is absolutely not popular these days. But all the way through to defense stocks, for example, that you might play because the world is getting more dangerous and we're deglobalizing, and perhaps we need to spend more on defense, for example. And you can invest single stocks connected with that, or there are many thematic funds out there as well. And I would love to elaborate on this. This is definitely my area of expertise, but I think that's where we'll leave it for the just now. And then, so we've touched on size, but there are other ways of slicing and dicing the universe. Sector funds are much more established, so they're recognized in every market, and you have, for example, technology stocks, you have utility stocks, you have consumer discretionary stocks, for example, and they're clustered together. They build similar types of products and sell similar types of sort of customers, and therefore are expected to behave similarly. And so you can often use these also as tools and ways of playing the market. So when Trump got elected, you could potentially invest in traditional energy sector fund, which would give you exposure to the renewed enthusiasm for that sector, for example. So again, they're tools, and each one tend to have characteristics that we mentioned before. So utilities would tend to have a value tilt, because once you're a utility provider, you have a very stable business, which gives you steady income, but you're not really looking to expand and grow. You're not trying to build the next AI model, which may change the whole world, for example. Okay, next slide. So again, we touched on this fixed income, sovereign. You can lend to sort of governments. You can lend to super governments. I don't want to overcomplicate things here again, but essentially these are different sort of entities that you can lend to. And so corporate lending is generally, though it's not always the case, considered to be less risky. It's generally more likely that your developed country is going to pay you back, and potentially, even than some of the biggest companies in the world, because we've seen on many occasions, big companies suffer and sort of default as well in the past. And so just finally, this isn't, not all bond investing is safe. High yield investing is essentially you're investing in companies that are maybe less likely to pay you back. So there's higher reward for you to invest in them. They are much less risky, but fundamentally they, it's also fixed income investing, but you have potentially higher returns, but also potentially higher risk as well. And finally, you can invest in green bonds. So this is connected with sustainable investing. And in this case, you're investing in debt that's explicitly being used for green projects. So potentially a wind farm or a solar farm. And essentially you're lending because you're getting less back on your investments when you invest with these, but you're also helping to channel capital to places where potentially you would like to see it used most. Okay, and finally, I have gone on a little bit here, but I'd really want to talk about active and passive. And we sort of touched on it before. I would encourage you, we publish regularly a free research, my team, called the Active Passive Barometer. And essentially, it shows you how successful active managers are in different markets. So whether it's equities, whether it's UK equities, whether it's US equities, or fixed income, or other different investment areas. To reiterate, active is when you're essentially giving money to a fund to bet against the market in some way, generally with the hope of outperforming the market. But sometimes there are other considerations. Sometimes you are just trying to reduce risk rather than outperform the market explicitly, or perhaps you're trying to invest sustainably. There are other reasons. There are other things you may incorporate as an active manager, and this is versus passive. So passive is literally the pure, in its purest form, is simply just buying the market in exactly the proportions that the market has dictated. So the largest companies get the largest weighting in the index, and essentially you're crowdsourcing the intelligence of the market. And you think that over long periods for a low cost, this will the investing in the market will be the best outcome for you. And our own research has unfortunately shown that. So the rise of passive investing has potentially been the most important change in the financial market, the asset management industry globally over maybe the last 20 or 30 years. This revelation that just by being diversified and harnessing the wisdom of all of those active bets in the market for a very low cost, you are extraordinarily difficult to beat over long periods of time. And on the screen, if you look, I've taken a screenshot from one of our active passive barometers, but you can see so this is the active equity funds in Europe rolling returns over certain periods. And you can see over any given 1 year period, sometimes the success rate peaks and sometimes more than half of the funds over a 1 year period are outperforming their index. But if you take the investment period out to 10 years, which is in purple, you can see all of those bumps are smoothed out, and 20% or less of active managers survive and outperform their benchmark, which in some ways is shocking. So if you're going to go active, you really should be careful about which active manager you choose, because on average you're not going to beat, as they call it, dumb beta or a passive fund at a very low cost. And so to help with that, at Morningstar we have Morningstar analyst ratings: gold, silver, bronze, neutral, negative, which should help you guide you towards the best investment. They are forward-looking, analyst-driven ratings, or in some cases analyst-driven ratings, which should help you really narrow down your investment options and sort of help you focus on at least the ones that have a better chance of outperforming their peers going forwards. And finally, not everything is risk and return. I also wanted to touch on sustainable investing and ethical investing. So this became one of the hot topics over the last couple of years. It's somewhat cooled off. In the US, there's been a backlash. I wouldn't say in Europe there's been so much of a backlash. But this is known broadly as ESG investing, which is environmental, social, and governance. So that these pillars that you're looking at in any investment, either at a company level, is it being run well? Is it being run well with regards to the environment? And is it being kind to its employees and society? So these are other considerations that you may want to make. And of course, at Morningstar, we have lots of data and research which can help you make those decisions as well. I do appreciate that I've sort of rushed through quite a lot there. I've covered a lot of ground, let's say, but I'm more than happy to answer any questions.
Thank you, Kenneth. Yes, we do have a number of questions, so I'm just going to run through some of them now, starting with the easiest one, maybe. So we have something from Urska, who's asking, can you please elaborate on the accumulating versus distributing ETFs?
Yeah, great question. So much like a stock, so as I mentioned, stocks pay dividends. And so when you invest in an ETF, you can choose often whether you want a share class which is accumulating or distributing. And a distributing share class will essentially take those dividends that the fund is being paid, and they pass them through to you as income. So if you require income for your retirement, or you need income for another reason, this is the distributing share class would be the one for you. There are different tax implications for capital gains versus sort of income. These are different in different regions, so I'd encourage you to look into that. But essentially, yes, you can choose to have these dividends distributed to you, or you can choose to have them automatically reinvested in the performance of your fund, which would be an accumulating share class.
Okay, Sarah is asking, have there been times where both stocks and bonds moved in the same direction? They both tanked, for example, and if so, why?
Yeah, just general market panic. When things get really, really tough, they would say there's a flight to quality. So I didn't mention some of the other. So quality is another thing you might look at when you're investing either in fixed income or in equities. But generally, when markets drop, there's a flight to quality. So you think, okay, I'm going to go to. So when Nvidia dropped, when Nvidia dropped 20%, Apple was up 3 or 4% when I checked it on the day, because there was a feeling that Apple isn't very exposed to this, and it's actually a quality stock. So there was a flight to quality there. In the COVID-19 panic, I believe bond prices and stock prices both dropped. And this was because there was so much uncertainty in the market. There was just a general panicked sell-off. There was a feeling of, we don't know what's going to happen here. This is a global pandemic. Is the whole world going to be different? Is the financial system going to be different? So there are occasions where the rule is broken, that these move separately, and that's why I was quite careful to make too many sort of sweeping statements. There are moments where you would expect certain instruments to do well, but ultimately it's humans at the end of the day, and they will sometimes panic, and they'll sell everything, and they'll act irrationally. And many would argue that that's exactly the time that the best opportunities are as well as an investor.
Okay, Elena is asking, she's years away from retirement. She understands the benefits of diversification. So should she diversify across asset classes, or sticking to equity is good?
Yeah, so it depends how far away. I'm not going to make give you sort of any advice, but what I would see in successful portfolios is that you would have a mix of equity and fixed income generally in your like that. The standard portfolio is known as a 60-40, 60% equity, 40% fixed income. And you would change this throughout your cycle given your needs. So as I did when I first started investing, I put a lot into equities, and I actually put them into riskier equities as well. So smaller cap investments, you can buy small cap funds, or sort of tilted towards some of the only small portions of my portfolio, but towards sort of long-term bets that I was making, alternative energy and such forth. So if you're a long way away from retirement, the received wisdom, let's say, is to have a higher portion in stocks, which are more volatile, but they're likely to give you more upside over many years. But as potentially as you get closer to retirement, you'd actually want, the downside matters more. You've got your wealth, you're trying to protect it, and you want some upside that you would increase your fixed income component.
Okay, another question from Santosh Krishna, who's asking, what is it that we are assessing in cryptos? For stocks, we look at a company's performance, and for bonds, the government that's selling the bond. But what is it for crypto? What is the driver for the prices going up and down?
Well, so I was actually in the Times this week talking about this exact thing. It's there is no fundamental value. It's driven by sentiment. There's a very good book called Number Go Up, which is almost self-explanatory, but it's about a certain period in the crypto industry, written by I think a Bloomberg journalist. It's very entertaining. On the one hand, crypto is clearly here to stay. It's found a place in the world. But if you're looking at it from a traditional investment lens, when we're looking at a stock, we're looking at its profitability in the future. Crypto, or at least the main crypto, Bitcoin, doesn't pay any returns. So you can't discount returns in the future. That's how you would value stocks. And actually, there is no fundamental value. It's mostly driven by sentiment. So how investors are feeling one day to the next. If you are going to, and there are some reasons to be invested in crypto, and there are reasons why it might be a useful asset in the world going forward, and the technology of peer-to-peer sort of currency and such forth is potentially interesting, and you can get some sort of exposure to that if you invest in some of the other coins. There are reasons to be invested in Bitcoin, but frankly, for most people, I wouldn't. And if I was to do it, I certainly wouldn't try and time the market. I wouldn't try and jump in and jump out. I would have it as a small portion of my portfolio, just for that potential upside. There is a potential; it could go to the moon, as they say. But that would be, I wouldn't. For my portfolio, I wouldn't go any further.
All right. Before I ask you the last question, I'm just going to pull up the QR code for the survey. If you could please just take a moment of your time to answer a few questions, that would be greatly appreciated. So here we go with that code. I'm showing it now. And the last question to you, Kenneth, is, as an expert, where do you expect markets to go in 2025?
Well, if I knew that, I'd be sitting on a beach somewhere and sipping a cocktail, I think. Listen, I think honestly, the biggest takeaway for me is that after many years of working with the markets, anyone who tells you they know what's going to happen, you should be immediately wary of that. We're living in a very uncertain world. I imagine many equity analysts 2 weeks ago were telling you something about NVIDIA, stock analysts, which suddenly changed. And within 2 weeks, they're telling you something completely different about where the market's going to go. Ultimately, investing is dealing with uncertainty. And, at its excesses, it can be something closer to gambling. Maybe people who are into sort of crypto and things and trade intraday, I would say that's closer to gambling than investing. But at its best and most secure, it's building a financial future for you and for the, potentially for your family. And it shouldn't be that entertaining. It should be boring, and it should be long term. And so where the markets go next year, frankly, shouldn't matter. You should be saying, look, if I'm well diversified, if I build a good portfolio, you're setting yourself up positively in life. And I think that's probably the key message for me. And I'm not against it. If you want to take if you want to take positions, if you really believe in something, or you want to take tactical bets, you're absolutely more than welcome to do that. But unfortunately, our own research has shown that most investors tend to buy and sell at exactly the wrong the wrong moments. They get excited at the top of the market, they think the boom's going to go forever, and then they sell in fear at the bottom of the market. So that's something to be wary of as well.
All right. Thank you very much, Kenneth, for your time and valuable insight. Thanks, everyone, for joining us today. Hope to see you for our next webinar. The slides for this webinar are attached in the room, so you can just download them. And I'm going to go back to the QR code. If you could please complete those questions, that would be greatly appreciated. Thank you, everyone, and see you next time. Bye.